Hi, it's Greg from the Investor Hub. I want to talk to you about mining towns again today. Some of our fans have been asking about some of the pros and cons of investing in mining towns. So let's define what a mining town is. A mining town is a place where the property market is undergoing fundamental change because of the presence of a resources project. Pretty simple. We're not talking about infrastructure towns, but the places where they actually drag the stuff out of the ground. Usually mining towns are characterised by quite high rental yields and potentially high capital growth in the initial period if you get your timing right. So basic portfolio theory tells us that for a higher risk you can expect a higher return and vice versa. So absorb that because it's quite important to the notion of risk and investment in mining areas. Mining towns are inherently higher risk, so the returns demonstrate that. Okay, so what sort of exposure does this type of property investor suit? Well, you have to have a higher risk tolerance. That's simple. So you'll be able to put up with the loss for higher returns, or the potential loss for higher returns. Secondly, you might need a high cash flow property as part of your portfolio. So it can be used as a balancing item if you've got a couple of cash flow negative properties in an area where you're expecting higher growth over a longer period of time, but less rental returns. A high cash flow property can offset that by actually funding that and being the fuel that fires the engine, which is a good idea. Or thirdly, your time frame may be shorter. So property investment is generally a longer term type of strategy, but in some of those areas, again, if you get your timing right, you can flip and sell and take a swifter capital return if that's what your strategy is. So what sort of investor does this not suit? It doesn't suit someone with low risk tolerance, and it doesn't suit someone who's relying purely on capital growth as their wealth accumulation strategy. If you're balancing it, as I mentioned before, that's okay. But if you're purely focused on capital appreciation, the risk may knock you out of this one. So you know what the pros are of investment property in mining areas. They're characterised by high rental return and potentially high capital growth in the early phases. So a lot of these towns will top the best performing area lists, but the question is for how long. So what are some of the questions you've got to ask yourself when you're doing your due diligence in some of those areas? Firstly, you need to know what the lifespan of the project is. How long is the mine going to be operational for? You need to look at infrastructure spending. Are they spending money developing the infrastructure of the town, rail, roads, hospitals, schools, commercial development and community infrastructure, not just commercial and business infrastructure? Is it a one-mine town? If something goes wrong, you've potentially got no tenant and your capital values can be knocked on the head by 80% overnight. And what phase of the mine development is the mine development in? So the largest amount of human resources are required for actually setting up mines. Once they're operational, they need less people to drag the stuff out of the ground. It's for setups and shutdowns that they need the most amount of people. What else? Lenders are less inclined to lend in some of these areas at the same kind of loan-to-value ratios that you'd certainly get in suburban areas. So you need to have a bit more skin in the game in some of these areas. So that's some of the pros and the cons of investing in mining towns. Next in the series, I'm going to focus on some of the core qualities for regional hotspots. Talk to you soon.